Hi, this is Accounting Space, your one-stop shop for all accounting and finance related topics. This lecture is on optimizing account receivable management in organization. What does account receivable entails? What does management of account receivable entails? Account receivable represent the outstanding payment owed to a company by its customers for goods and services provided on credit. Now, I want you to take note of these terms. They're very, very important when it comes to account payables. There are goods and services. There is also a company that has supplied its customers. There's also a goods supplied on credit. These things are very, very key when it comes to understanding the nitty-gritty of account receivables. Now, what is the significance of account receivables for an organization? Account receivable is crucial, plays a crucial role in maintaining a steady cash flow, enhancing liquidity, and supporting day-to-day operations by converting credit sales into cash inflows. Exactly. Now, what does that mean? You supplied a particular vendor, a particular customer rather, 5 million naira worth of good, 10 million naira worth of good, 100 million naira worth of goods. Now, there's an agreement for the customer to pay after 30 days or after 90 days or after 45 days or 15 days, depending on the agreement you have with the customer, right? Now, that customer gets to pay at that stipulated period based on control, follow-ups, and calls. Now, what account receivable does is it converts that credit sales that you have not received the actual money into actual inflow in the bank account. So monies you're expecting people to pay with follow-up and account receivable management, it's quickly turned into a receivable, right? Which is under your current asset down to actual cash or cash inflow into the bank, which of course falls your bank or cash and cash equivalent in your balance sheet or statement of financial position. Now, the impact of poor account receivable management. Uh, when you have as an organization, your accountant is not up to speed when it comes to managing your account receivables, it comes with a lot of issues to the operational deficiencies or inefficiency in the organization. Now, you're going to have, first of all, you're going to have cash flow problems because you're not going to have as much inflow because people are owing you, right? Because that money you've used to supply uh, those customers on credit, you need the cash back to be able to buy more goods or supply or add to your inventory or make more purchases in order to pay or supply these customers. Now, another thing here is increased bad debt. Now, when you say bad debt, what are bad debts? Bad debts are debts that has been deemed not recoverable. Now, when you don't have a good account receivable management where your records are not up to date, when you don't have an ID for each of the customers that you're giving to on credit, when you don't have a limitation for each of the customers you're giving to on credit, when you don't have an SLA, you don't have an agreement, you don't have a policy within the organization that governs how account receivable is managed, it leads to increased bad debt. That means those monies that customers are owing you outside, it gets to a point when the money is owed up onto 1 year, 2 years, 3 years, it becomes difficult to recover those monies because they've stayed too long, right? And sometimes the staff that was there when this transaction took place must have left, no inability to get invoice, inability to get good records, pull out the ledger for each of those transactions. It becomes very tedious when you don't have a good record keeping or managing account receivable for an organization. It leads to bad debt. You get to lose money every now and then. Another impact of not managing account receivable properly is negative impact on credit rating, right? So it affects also the credit rating of the customer. Operational inefficiencies. Yes, so once cash flow, when cash is not coming in as and when due, because operations will not stop. You need to buy in diesel, you need to buy in paying salaries, you need to pay in wages, you need to buy inventory to be able to supply other customers that are that are on cash basis. Now, you need to know that for most businesses, there are two types of customers. A customer that comes to pay you on cash basis, cash and carry. It walks into your organization, or walks into your or calls or makes an online order and pays before you deliver to them, or they pay on the counter in your organization. Those are cash basis customer. Now we have the credit basis of customer, which is what we are talking about here, the account receivables. They form part of your current asset. And this type of customers, when you don't have a good and proper accounting records, it becomes difficult to get back your cash. And when you don't have your cash inflow on time, it then affects your operational processes and causes inefficiency in the administration or operational structure of the organization. Now, setting up effective account receivable policies. Now, for you to have an efficient or manage your account receivables properly, there has to be, it is compulsory that you must have policies that guides how you treat your account receivables, your customers that are under your account receivable. There has to be approval. Anybody cannot just come and say, okay, this person is we're going to be giving this person on credit. Is the management aware? Even though the management is aware, what is the limit to each of the customer, or what is the limit to this particular customer you're bringing in on board? Is the person vetted? Is the person a registered business? What kind of business does he do? Have you gone to the site? I mean, these and many more questions are very key when it comes to managing account receivables or formulating policies that surrounds account receivables. First of all is establishing clear credit policy, which is very, very key. Establishing clear credit policy. Now, another one is defining credit terms and condition. So when you say credit terms and condition, now for some client, the credit term you may give them may be different from other customers, largely due to the fact that what they are coming to buy, they are buying larger quantities compared to other customers. So you need to give them some sort of leverage, some sort of rebate, discount, commission, or whatever it is you call it in your organization, to help foster payment of these receivables, right? Because they're buying in large quantity. So payment terms and conditions, defining them in a well-tailored way is very, very important. Regular review of and updating of credit policy. Now, there are times when you have a policy or service level agreement with an organization or with a customer. There is need to constantly review this agreement you have with your customer, because so many things happens. The cost of doing business majorly affects or influences these policies. The prices you give to a customer 2 years ago, or 5 years ago, or 3 years ago will not be the same price you're going to give to that customer at this current prevalent rate. Take, for example, the inflation rate in Nigeria at the point was, when you signed the agreement, was 15%. Now, inflation rate is over 30%. How would you still keep that policy running with that customer? You're going to be shooting yourself in the foot, right? You're going to be selling at a loss to that customer, and the customer is going to be happy. So there's need to constantly review the credit policy, the service level agreement you have with the customer that has been categorized or approved to be under account receivables. Now, account receivable management process flow, invoicing. Now, when you have invoicing, so sometimes depending on the structure of organization, most organizations don't use, this is a practical view now of what happens with the process flow of account receivable management. Now, invoicing: generate a sound, accurate invoice to customers properly. Follow up: implement a systemic follow-up process for outstanding payment, right? So a customer sends you an invoice, you process it and ensure that it's promptly processed. Now follow up again. Once you have supplied and delivered these items or delivered these goods and services to the customer, there is need to follow up with that customer to foster early and prompt payment. This is very, very key when it comes to account receivable management. If you don't have, if you don't follow up, and if there is a need to come up, if there's a need for reconciliation, it then becomes difficult to even reconcile because you've not even follow up. If, for example, there's some sort of discrepancy or disagreement, as to certain items that you supplied but was returned back to your organization and you didn't know about it, and now you have billed them 100,000 naira and they're saying no, our money is 50,000 naira. That's because some half of the items you supplied were returned back without your knowledge. So there's need to constantly review, do a follow up and review the account receivable of the organization. Customer communication. It is important to have a contact person to speak with at every point in time. Payment terms. You need to have an agreement with the customer. Is he going to pay 50%? Are you giving him a net of 30 days, net of 15 days, net of 45 days, net of 60 days, net of 90 days? Some even do net of 180 days. Now, depending on the volume and the value of the transaction, take very note of what I'm saying. Depending on the volume and the value, if the value is high, right, and the nature as well. Now if it will require you to import certain items to deliver to a customer, all these things are the things that will factor in or that will determine your payment terms, right? So the value of the kind of business you're dealing with the customer, the volume of it, and the nature of that business, all form or constitute to your payment terms, which is very, very important. Escalation. Now, escalation is also part of reconciliation, where a customer has refuted, you sent in your balance to a customer. You are owing us 100 million naira, or you are owing us 5 million naira, or you are owing us 10 million naira. And the customer said, no, we are not owing you that much. We are not even owing you at all. Now, there's need when you get that to escalate to say, okay, why are you claiming that you are not owing us? Based on the record we have, you are owing us this set amount, or your balance with us, or the balance you have outstanding is 10 million naira, is 5 million naira, is 50 million naira, depending on the transaction that has transpired. Now, reporting as well, regular monitoring and analyze account receivable reports to track progress and identify bottlenecks. Now, there is need to constantly have a reconciliation, reconcile reports. So there's account receivable report that shows each and every transaction on a daily basis. It is very key that you maintain a daily transaction or record of the account receivable with customer on a daily basis, and then you can group it to month, you can group it on a quarterly basis, you can group it on a biannually basis or a yearly basis, but there is a need to have it on a daily basis so that it is easy to reconcile in the event where one or both parties escalate the balance. So reporting here for me is very, very important. That is the heart. If you ask me, that is the heart of account receivable, because in that reporting it talks about the price, right? The pricing is also very key. If we have an understanding that if you are supplying less than this quantity, you're going to give me this price. If you're supplying above this quantity, you're going to give me this price. Now, if you supply me less than the quantity and you're giving me another price, that means it's not going to work. So there is need to have a reporting that checks the goods supplied, the quantity, the item, and all the other details that has been agreed upon in the payment terms. This is very, very important. Now, we have technology solutions for account receivable management. Now, it is very important we take note of these things. They're very, very important. Automated invoicing system. There are softwares that have been designed to cater for account receivables and account receivables alone for organizations. It is different from your normal accounting software. There are organizations that the account receivables department, the people working under account receivable is as much as 20. Yes. So depending on the kind of business, the kind of industry you are in, the country you are in, there's need sometimes to have a separate accounting software because of the volume of transactions you are doing on a daily basis, on a hourly basis even. So there's need sometimes to have an automated invoicing system. Now there's also need to have automated management software, and yeah, so which is very very key. We have an invoicing system, we have a software. All these things are technologies that has been put forward to enhance account receivable management, efficient account receivable management. Benefit of technology integration. So that cannot be overemphasized. Technology has helped to integrate and track our account receivables ever since. So benefit of account receivable, this is very key. So there's also the need to monitor account receivable performance. Now, you want to know if a customer has been paying, right? There's also a need to monitor that. Is this person just collecting goods and services from you? Is this customer just collecting goods and services from you? Is not paying up? Or as the goods and services the person is collecting from you reduced? Or what kind of goods and services are this person or is this particular customer demanding from you or demanding you supply to them? These and many more questions are very key to identifying and monitoring account receivables. So key performance indicator, identify and utilize essential KPIs to evaluate and enhance AR performance, which is very key. So utilizing essential KPIs. So what are the KPIs for an organization? You have signed an SLA that okay, you're going to be demanding, we're going to be supplying you 10 tons every month. If that 10 tons is reducing or is not coming forth or they're not demanding as much as that means they're not meeting up with their KPI. Tracking AR performance, leveraging KPI to monitor and analyze AR performance trends for informed decision making, which is very very key. You need to track it to be able to take decision. What are these customers demanding for? Why are they demanding for these particular services? Is there something we can do better? So it helps you to, when you have this report, it helps you to engage the customer at a very intimate level, at not just being at the transactionary level where you just supply goods, at a level where you now be able to grow to the level where okay, much more than let's just transact business. What are your needs? Right? We see that you've been demanding A, B, C goods. Are there other types of goods or services you demand from us based on the kind of business you're running? Now, all this information will be possible if you have your records up and running. Regular reporting. So there's need to constantly on a weekly basis, I would suggest weekly basis, you submit an account receivable report. It is very, very essential to submit account receivable report. It is not optional, it is compulsory. Now, when you're submitting account receivable to you have to submit it to the management or to your HOD finance. This would help in the executive management in taking key decisions that will help them in the organization. This is also very, very important. Case study of AR optimization. Utilize data analytics. It helps a lot. You know the kind of goods they are demanding, the services they're demanding, why they're demanding the services. Data analytics will pick that out for you. Automated invoicing process. We've talked about that. Enhanced communication channels. There's need to have a very very sound communication channel with your customer. It is non-negotiable. It is compulsory. Establish clear payment terms. Your payment terms needs to be very clear. 60 days is 60 days, 30 days is 30 days, 40 days is 40 days, depending on whatever payment terms you are demanding. And in the event where the person is not meeting up with that payment term, you cannot resupply the person, even though the person demands that you send them goods and services. Now, for organizations, they always have a limit, like I rightly said. There's limit to what you give to a customer after a period of time. Now, in this chart, it clearly says that If a customer, we can only give a customer 25,000 naira between 0 to 30 days. That's the highest a customer should have. Now, between 31 days to 60 days is $15 or 15 naira. But now, between 60 days to 90 days, it is 10,000 naira. Now, between over 90 days is 5,000. Now, what does that mean? We rightly said bad debt. Now, the longer this money stay out there, the difficult it becomes for them to be recovered, which then leads to bad debt or unrecovered monies outside there. Now, there is need to have this monitored. Now, when you set that limit, anybody that is owing above, for example, that has crossed above 30 days, is in its 50th day, and is owing maybe $30 or 30 naira, 30,000 naira, there is need to stop supplying the person immediately and send reminders, do a follow-up call, and ensure that these monies are paid before any other thing is done. Sometimes some organizations place these people on suspension. It is very, very important. Now, strategies for days sales of standing, reducing your account receivables. Implement early payment incentives. So when you have, like I already said, early payment incentive are okay. You are buying this from 10,000 tons or 10,000 quantity and above, will give you a 3% discount, right? Those are things that foster early payment. Or if you pay on time, you're going to discount 3% off it. All those things are just measures and strategies to ensure that customers pay up their money on time. Strengthening customer relationship. There is need to have a very, very sound customer relationship. Build a viable customer relationship with your customers that you supply goods and services. Regular follow-up and reminders. This cannot be overemphasized. Now, when somebody is owing you, it's just courtesy, right? For you to engage them and follow up. Now, when you say you are following up, there is a mark. Once the person crosses the mark of say $25,000 or 25,000 naira after 30 days, there's need to follow up to reduce it, because the rule is that it must not, once you cross 30 days, the balance with us must be below 15,000 and below. Now, if you're having 25,000 naira by 50 day or 40th day, that means we are not doing a good follow up to ensure that you pay back, right? So it's very important that follow up is done. Now, SWOT analysis of account receivable, which is very self-explanatory. Strength. So efficient invoicing processing, utilization of technology, strong customer relationship. So for this, you need to know that for account receivables rather, you need to have efficient invoicing process, utilization of technology, strong customer relationship. So part of the customer relationship is follow up. Now, opportunities. What are the opportunities when you have an efficient account receivable management? Market expansion opportunities, adoption of advanced system, strategy, partnership. Now, what are the weaknesses? Manual processing, lack of data analytics, inadequate staffing and training. Now, when you don't have adequate staff, well-trained staff, or you don't have data analytics to help you process your data, to be able to pinpoint what is wrong or why are the sales or the demand or the order, the order from these customers are reducing. So it's data analytics or your analytics person that will be able to pick it up for you. Now, what are the threats? Economic uncertainties, increasing competition, regulatory changes. Now, there's constantly regulatory changes happening in the economy. A case in point was what I made mention of, having inflation at 15% and still doing business with the person at 15% when your reality is at 30% inflation rate. It does not make any sense at all. Best practice for account receivable management: regular review of credit policy. This is very, very important. Use of technology to automate processes. And the third one is maintain clear communication with customer. This is very, very important. Future trends of in account receivable, blockchain, AI, embracing growth opportunities, which we all know. Thank you very much. Now, in order to buttress on a practical basis, what I've said so far, I'd like us to go to a practice question. Case study 1. Dangote Cement Limited sold 5,000 bags of cement at 10,000 each to Mr. Emeka on the 25th of April 2023. On 3rd of June 2023, Dangote Cement sold on credit the sum of 1,000 bags of cement to Mr. Emeka. There exists a signed agreement between Mr. Emeka and Dangote Cement Limited that customer must pay ahead before goods and services are delivered. That is the agreement Dangote Limited has with Mr. Emeka. However, on the 21st of March 2023, Mr. Emeka paid the sum of 50 million naira to Dangote Cement, which receipt was confirmed. They are required to show the accounting entries in the books of Dangote Cement Limited. Now, this is a bit tricky question. I say tricky because if you don't understand certain principles, you may miss or misinterpret the concept here. Now, let me pick it one by one. Dangote Cement Limited sold 5,000 bags of cement at 10,000 each to Mr. Emeka on the 25th of April 2023. So on the 25th, of April, Dangote Cement received on the 25th. Where is it? Okay, 25th of April. Dangote Cement gave 5,000 bags to Mr. Emeka. So in the books of Dangote Limited, you debit Emeka account, you credit sales account. Why are we crediting sales account with 50 million, 5,000 bags sold to Mr. Emeka? Why are we crediting sales account? Because under IFRS 15, the standard states that you recognize revenue when performance obligation has been met. Now, the performance obligation here is that Dangote Limited has delivered 5,000 bags to Mr. Emeka. Even though Dangote Limited may not have received money or may have received money, the rule of engagement is that once performance obligation is met, you record revenue for that point in time. So on the 25th of April, we debit Emeka credit sales account in the books of Dangote Cement Limited. Now let's go to the next one. Dangote Cement Limited sold on credit 1,000. We've treated this one. Dangote Cement Limited on credit sold the sum of 1,000 bags of cement to Mr. Emeka. So how do we treat this transaction? So let's start from on the 25th. So let's go back to based on the date. Now on the 25th of March 2023, Mr. Emeka had paid 50 million ahead to Dangote Limited. Now what that means is, based on the agreement Dangote Limited has with Mr. Emeka, that before Dangote Cement Limited would supply to Mr. Emeka, money must have been paid for the goods ahead before supply is made. That is the service level agreement, right? Now, different organizations with different policies, you need to stick by it. So on the 25th of March, Emeka transferred 50 million to Dangote Limited. Now, what this means is, take a look at this income liability account. What does this mean? Now, under IFRS 15, the law says that when a customer transfers money to you ahead or gives you money ahead and you are yet to satisfy your performance obligation, the rule of engagement says that you must recognize that money as an income liability because performance obligation for that money received has not been met. You can't match it, right? You can't match that money in your account to any sale. You can't match it to anything that you did not dispose any asset. You did not sell anything. So ideally, what the standard says that you recognize that 50 million as an income liability, and that's why it's recognized here as an income liability. So you debit Dangote Cement Limited and credit income liability account with 5 million naira paid to Dangote Limited. Now, on the 25th, Dangote Limited then, based on the fact that they've received the payment, on the 25th of April, Dangote Cement Limited supplied the 5,000 bags, which the cost of the 5,000 bags at 10,000 naira each is 50 million naira, which is the 50 million naira Dangote Limited as supplied. Sorry, my apologies. This is meant to be 50 million, not 5 million. My apologies. This is meant to be 50 million naira. My deepest apologies. Which is, now, let's go to the next one. We've been able to track the 5,000 bags that has been supplied to Mr. Emeka. Now, let's also look at, now this other entry. Let me try and explain this third accounting entry, this one here on the 25th, right? Now, in other assets, when you're as an accountant, when you're reporting on at the month end, 30th of March 2023, in your balance sheet, it will show that there's an income liability in the account of 50 million naira, right? So that when management, because it's you're just going to shoot your money up, and they'll be like, why do we have this much sales in the account when we did not sell? What did we sell? So that management can know that, okay, we have a 5 million naira in the 50 million naira in the account that is not our own yet because we have not supplied the items to the customer. Now, by 25th, when the items are supplied to Mr. Emeka, because it is already in income liability, you need to reverse the entry, right? So that it shows that Emeka gave to income, has been able to pay his debt, because here sales account here gave to Emeka, which is the 5,000 bags. Now Emeka is part of is an account receivable. At the month end, it's going to be showing that Emeka is owing 50 million naira, which is not true because he had already paid. Now, it is also very good that at that point you knock it off by crediting Emeka account and debiting income liability account. This is very, very, very important in order to have a balanced account and reporting. Now, the next one would be that on the there's this okay, so the next one is, however, on the 25th of March, which is where we are going actually. On the 21st of March 2023, Mr. Emeka paid the sum of 50 million naira to Dangote, which was confirmed. No, this is not where I want us to go. Okay, yeah. On the 30th of June 2023, Mr. Emeka and Dangote Cement sold on credit the sum of 1,000 bags of cement to Mr. Emeka. Now, how do you account for this particular transaction? This is the transaction I'm talking here. This particular one on the 30th of June. On the 30th of June, I'm underlining it now. The 1,000 bags on the 30th of June. Now, the accounting entry is maybe based on relationship. That's one of the reasons why in the lecture you'd notice that I said have a very good customer relationship with your vendor. There's need to have that relationship. So I want to believe Mr. Emeka said, you know what, just give me 1,000 bags. I know we have an agreement that I'm meant to pay you before this, but just give me 1,000 bags based on relationship. This is more like off the books based on relationship that has been built over the years. So it is important for you to maintain that customer relationship. It is very, very important. Now, on the 30th of June, Emeka received um, 10 million naira worth of bags of cement. 10 million naira worth of bag of cement. So the accounting entry is to debit Emeka account and credit sales account because performance obligation has been met. Now what that means is at the 30th by 30th of June, it will be showing in the books that Emeka is owing Dangote Limited, Cement Limited, 10 million naira worth of cement or worth of goods that have been supplied to him as at the end of 30th of June 2023. I hope this is very explicit. If you have any other question, I'm very available. Send email to akoutenspace@gmail.com. I'll be expecting your questions and I'll be ready, very available to shed more light into this. Thank you very much. God bless.